With the S&P 500 now up 30% from its April low, making new all-time highs and having achieved 3 of our pattern targets already, the obvious question is, what comes next? Well, the answer is the second up leg, which we'll be diving deep into today across various charts. So let's start with looking at the fact that the S&P is up 30% from the April 7th intraday low here. And we know that all of that basically was because of the 90-day tariff reprieve announced on April 9th, and just an historic rally that day across numerous stocks, right? And so that led us to, of course, really an unstoppable rally up until just a few days ago, with the intraday advance hurdling 30%. So Monday, July 7th, we know we got some new tariff news, and arguably it wasn't great. That's an important point because, as you recall, anything tariff related on the way down, especially in March and April, was received in the worst way possible, with some historic declines to the point where it obviously was an all-out crash until things changed back in the second week of April. So again, with the rubber band of the market stretched all the way now, the pendulum swung from one extreme to the other. Again, now above the spot where we started from, you would think that any type of perceived bad news at this point could have been reacted to in the worst way possible, at least given us a bigger decline that we've seen in recent weeks. But of course, that hasn't happened up to this point. And we know that the market tends to run out of steam when even good news isn't capitalized upon. So we're still waiting for that to happen at this point. So as of right now, news overall has been digested well, and that is an important factor to consider as we go forward through July, which of course has the Fed meeting and earnings season as well. So that being the case, the drawdowns clearly remain very shallow. And going back to this April 21st higher low, which was really, from our perspective, which really changed things, because from that point, the rally became much more consistent. As we can tell, the biggest pullback the entire time was just about 3.5% in the middle of May. And from that point, been non-existent. So we know at some point, we're going to get a pullback that's much greater than we've seen so far. And, we looked at this 2-hour chart numerous times over the last number of months. And as we can tell, the 14-period RSI is coming off in a very extreme reading, similar to what it was in May. Now, that had to be neutralized, which it typically is. Even in the strongest markets, that will tend to oscillate back and forth. And in May, even though that pullback was only 3.5%, the RSI almost got to oversold territory. Again, getting to oversold in a very short time period like this is not a very bearish signal. If it happens over and over again, more importantly, if the RSI fails to get back to overbought, like we saw for an extended period of time from the February high, or actually this is going back to January up until May, that gives us an obvious sign that the market was struggling. And so the question is, looking at this, how much further can the S&P 500 go without experiencing a much bigger pullback? Well, we can go back to a period that was in our recent memory for a time when that did occur. We're, of course, talking about November 2020 through to April 2024. This was the October 27th low. So we started on October 30th the following week. And up until that point, obviously a very strong rally from the low. We had a number of breadth thrusts like we had again this time. And we can tell that it went all the way until the end of March before we saw a pullback even greater than 2.5%. So remember, we already had one that's down that was about 3.5% from the high. This one was much shallower and much more consistent. So we're talking about 5 months worth of action nearly before we had something even more severe. And this was not even a 10% pullback, right, from the March high to the April low. And along the way, of course, we had overbought readings on a short-term basis, but those never persisted for longer than, say, a few days or so, and came down and didn't get back to oversold until the April low. But along the way, it got close, right? Was in the 20s a number of times, even as the pullbacks remained extremely shallow. So looking at both of these side by side, you can tell, of course, that they are pretty similar so far. And so we don't have to go another 2 months of this to completely match what we just saw. At the same time, it's not out of the question because we just saw it happen. And even after that pullback from March to April, that didn't wreck anything, as we know. That was the real first dip that was bought. And after that point, the market continued higher, of course. So another part to consider is that the market continues to make higher lows. And that's obvious. But at the same time, as the market was pulling back, the S&P in the middle of May, a lot of people, of course, were doubtful that we could have that dip bought. Now, the reasoning is very easy. Up to that point, about 20% advance in a very short amount of time, getting right back to the 6,000 area, which has, of course, round number significance. Right above that was the digestive area that had given the market a lot of trouble ever since first touching it, say in November, December, January, February. So obvious resistance at that point, with the knowledge that the S&P just couldn't get above it for longer than a few days at a time. But when that did occur, and we saw a little bit of a bid here, we asked the question is, what happens if maybe this is very similar to the other pullbacks that we saw in recent years, where the volatility event happened, we get the first bounce, then the shallower pullback, which of course creates the higher low, which we saw in May, and again in September. And then the ensuing rally, the second leg, ends up being longer. Not maybe as strong, because again, the initial pushes off of these lows are typically much more explosive. But the second part can be more consistent and bringing us to much higher prices. And so far, that has played out. Now, of course, this isn't quite as extended as the initial push was this time in historic fashion. But at the same time, as we know, as things have progressed, what's happened? The price action has become calmer and more consistent, which is typically what you see as a market then gets into a more mature phase that can last for many more months. It just may put us to sleep along the way. So if you like this content and want to see more of it, visit CappThesis.com. This is where all of the charts come from. We go deep into many other areas of the market besides the S&P 500, including daily chart trades for individual stocks. So that has been able to happen, as we know, from low to a volatility. And as we all know by now, if we look at this in terms of just a minimal amount of 1% moves, especially 1% declines. And so this is exactly what this chart shows, which we've talked about before, but it's looking at the same periods. Remember, going back to this, right? The April low, the May higher low, the August low, the September higher low, right? And if we go back down to here, same type of thing, right? April low, May higher low, August low, September higher low. Once the S&P then emerged from those periods or those trading ranges, trading boxes, whatever you want to call it, that's when the extension went higher and became more consistent and calmer, which now, of course, has happened once more. We can see this more clearly if we look at just the daily price action. Again, right after that last April 21st big decline, how many 1% declines has the S&P endured since then? We're talking about 52 trading sessions, of course, just two, one in May 21st, and then one in June 13th, compared to 9 1% gains. That, of course, is a recipe for a market to move higher. And going forward, if this continues, I would assume that we don't even get as many 1% gains going forward, because as we know, when the most consistent and trustworthy markets, we don't need to see big moves on either side. That's what helps bullish patterns form and breakouts to come from them. So in terms of breadth, I thought this was an interesting way to look at this, just comparing or looking at the number of S&P 500 components trading above their 200-day, 50-day, and 20-day. Because as we know, it's very helpful to gauge the extremes when these move back and forth. So at the low, no surprises, things got extremely low, and that ended up being a good sign for the market to rally. But what we have profiled here instead are the times when the market topped going back to 2022. And it's interesting to see what those percent lines look like along the way. Not surprising, of course, when you typically get a spike in with the stocks above 50-day, 20, and 200, that just shows that there's finally exhaustion in the system, and eventually the market will have to pull back. So right now, there's about 65% of the S&P 500 trading above their respective 200-day moving averages. And so not quite back to the highs that we saw from 2024 or so, but getting closer, especially from bouncing back from the low from a few weeks ago. Now, some people have pointed out that we're right back to the levels that we saw in February, right before the market fell apart, and saying that this is a very bearish sign. And of course, we don't discount anything. Let's think about this for a second. It's not really apples to apples, because this, of course, that 65% number or thereabouts was a result of the number or percentage of stocks trading above their 200-day moving averages slowly unwinding. So even though the market was able to rally over that time frame, you can tell that the foundation was slowly eroding a bit, to the point where by the time it failed at that bullish pattern breakout near all-time highs in February, this was already lower. And that just added to the already underlying weakness that was happening, and everything moving together, of course, caused that waterfall decline, which we know was because of the tariffs, but I would argue that things were under the surface technically not strong, which increased the intensity of that. So the last time that the market was coming back from a volatility event and finally hit 65% of its stocks above the 200-day moving average was, surprise, surprise, the area or the time period we just talked about in November and December 2023, which we know then led to additional weeks and months of uptrending action. So we'll see if this continues. We know this is not completely representative of what happened back here, because this rally was so much stronger off the lows. It took so much more to get us back above those highs. At the same time, from a percentage of stocks trading above their long-term moving averages, it's quite similar. And that could just suggest that this still has much more to go. So looking at the weekly moving averages, no surprises after last week, the S&P continues to trade above each of the key moving averages, right? 13-week, 26, and 40, and now trading much further above each one of them. So now let's compare this to what's happened since 2020. And as we know, the best rally since that point, 2020 into 2021, and then coming back from the 2022 bear market, a few things changed along the way. Eventually, the shorter term moving average, the 13-week, trading above as you think they would, right? Short term, intermediate term, longer term, with the index trading above each of them, as the epitome of a long-term uptrend. So that will need to change eventually to make this comeback appear like we saw again in the second half of these rallies. Also, let's not forget that on occasion, the S&P can get extended from even those longer term lines, which it appears to be again now. And along the way, that would just have to has meant that the S&P or the market has pulled back more than usual, sometimes resulting in a correction, sometimes maybe not as severe, but at least a pause then that has the S&P in the past at least holding near that middle line, a 26-week moving average, and then continuing higher. So would not be surprised to see that happen again relatively soon as well. And again, that could also mean that these lines are catching up to the index. So if it tends to slow down, maybe even just move sideways net for a number of weeks, that could help those moving averages catch up. S&P can then bounce above them and then start to form a trend like we saw twice over the last few years. So in terms of the daily trend, we've been looking at the GoNoGo charts for this. And back here, first time that it flipped to bullish or it got a go signal was in early May, right before the pullback later in the month, but it held in there. So the daily trend continues to be supportive and confirm what we're seeing in the market across different viewpoints as well. Now, from a weekly perspective, we've been waiting for that to occur. So as we can imagine, with a weekly chart, the inputs that the indicator uses, of course, are also on the lag because things need to turn, whether it's looking at moving averages, momentum indicators, so forth and so on. We needed to see much more evidence of the market turning before that actually gave us the buy signal, which has happened now 3 weeks ago. So we're potentially in week 4 of this. So missing the good part of the move, but at the same time, let's remember what's happened in the past, where we can see here that once we got the buy signal or the go sign with the weekly trend flipping to bullish, a lot more was in the tank for prior times going back to 2015 to 16. And we can go even further back for other examples, but the hope is here that with the market just having triggered that bullish trend on a weekly basis once more, that it has a lot more upside to go with this yellow arrow, for lack of a better term, being longer and matching some of these strongest moves that we've seen in recent years. And we can see this going back even further, back to 2013. And what we did here was just try to remove the noise, profiling the strongest and or most volatile trends. And as we can tell, with a very quick glimpse, that the blue arrows, number one, have lasted a lot longer than the red. And almost every time, the blue arrows have also signified new highs, with many of them making new highs and then extending further for months, sometimes years after the break. So from that perspective, this could again just be the beginning stages of a much longer advance that could get us to much higher prices. And so one of the ways that's going to happen, as we know, is through the pattern work. And as of right now, we have two bullish patterns at play with targets of 65.55 and 67.45. That's important and really to understand as well that we're about 5 and 8% away from those targets being achieved. Much more important is the fact that we're still between 7 and 9% above the breakout zone. So why is that important? Because the market can now back and fill a good amount and still have those targets in play. So the cushion continues to grow. So it's important to realize that those targets remain in place, but also it gives the S&P the ability to now form new shorter term bullish formations to take advantage of. And when that happens, and when we see more of those bullish patterns leveraged and their targets hit, that just increases our conviction that these longer term targets can be achieved. To signify where the breakout zones are, we started coloring this in green and red just to give us an idea if and when we're getting to a danger zone, so to speak, but it really only happened just one time, again, during that May pullback, and didn't even get tested really after those first few days. Same type of thing with the 67.45 target. Only one time during that May pullback, and of course much higher from there. And then there was always the next pattern. And from this perspective, as of now, because the market just continues to float higher, we don't have any shorter term ones. We may get that with a lot more back and forth movement. But at this point, it's about looking at this big potential pattern, right? That's still in place, which could play out if we do get some consolidation now over the next few weeks, even a few months. And again, it has the ability to back and fill a lot and still have a structure like this as a potential to play out. If you want to see exactly how this played out during that period we were mentioning in April 2024, you're in luck because we recorded a video all about it when it was happening in real time. Check it out.